welcome again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us for our Happy Valentine's Day edition. It's February 14th. It's a Tuesday of 2023. Let's get right into our market insights and observations, and thanks for watching. Right out of the gate, we had this morning's most important economic data report. It's the CPI report that we've been waiting on. It's the January number. And across the board, under every category, unfortunately, inflation is still beating expectations. It's still coming in hot. It was a 0.5% versus the 0.4%, which was expected. Even on the core side, if we strip out food and energy, which you really can't because it's all about kitchen table economics, what you and I spend money on. But the government and the Federal Reserve say, hey, listen, forget about the food and energy. Let's just look at the core. And the core is still rising. So the take-home point is it's inflation's at 6.4% right now. So we're going to talk about the sticky inflation watch, and that's the concern of the Federal Reserve. And we're also going to talk about the oil and energy moving higher, or can they? They're trading down a little bit today, but oil. If you've watched oil, it's been moving up recently, and the question is, will that trend continue? And we'll talk about that as well. And then stay close because we've got a special guest later today, and we're excited to have that. So we'll get right to it right now. So the CPI report month over month, it's nothing new, as I just said, at this moment in time. Right now, you still have a good trend line. Let me see if I can get a color here for us. The trend line is still there. It's the second month where the month over month gains are still a little bit higher. And so this is really going to put, basically what does this mean? It's going to put pressure on the Federal Reserve to move again, a 25 basis point hike, and potentially maybe two more. If you look at the sort of the short-term treasury market and how yields rose as a result of this, they're basically telling us that the Federal Reserve has much more work to do, and that makes sense given the inflation is hot. Now, if we look at inflation underneath the hood in the CPI for the January report, we have shelter was up, we have energy was up, we have food was up, and then if you're looking at the grocery store, eggs were up, and this is shocking. Not only for the month of January, eggs were up 8.5%, but year over year, eggs were up right now, according to the government number, 70%. So there's a clear issue with regards to sort of how inflation is working its way. I mean, a few years ago, about a year ago this time, it was lumber, and it was used car prices. The good news is if we look at those are coming down year over year. But there's another way that inflation is working its way in. So the real key is, and the real question is, what's the stickiness inside the report? Is it wage inflation, which is what the Fed is tremendously concerned with? But we believe over time there's that lag effect that there will be an impact of all of the cumulative sort of rate hikes. And so that's slowing the economy. It's reducing the velocity of money. It's making it more expensive for companies to borrow, and therefore they have to manage their balance sheets, and therefore they're going to have to start getting rid of some employees. We're seeing that every single day in the Wall Street Journal. If you look, one company after another is either freezing their hiring or laying off to preserve their bottom line, to preserve protect themselves moving forward with an uncertainty with regards to how long will interest rates be this high, and how long will that last, and then the carrying costs inside when you're a business owner and you have some debt on the balance sheet like a lot of these corporations do, that is impacting earnings. And that's what we're going to see, the give and the get. So rising of the interest rates are going to make borrowing costs not only for the consumer but for companies, and therefore they're going to start reducing their workforce. And that's what the slack in the labor market, at least what the Federal Reserve is trying to attempt to make happen, but that will take time. But in the interim, another sticky part of inflation is the rents. So there's a good leading indicator right now. If you look at the Zillow report, and this right here is showing us more timely rent data is already showing us that rents are rolling over considerably. So this red dotted line right here that you're seeing has already rolled over, and this is the Zillow rent index, and it's essentially year over year and month over month. Now, what's the blue line? The blue line is still what's reported in the government report for rents. So it's always behind based upon the way the government calculates it. And rents moving forward, essentially what people are looking to throw their home on the market and test the market. We're seeing considerably basically disinflationary prices right now on the rent side, which is a good thing. Again, that just means that affordability is coming into play. And again, it's another element in terms of the CPI that the Federal Reserve needs to see inflation come down. The next chart is the chart of the day. And it's basically, we were surprised to see that the U.S. is selling more oil from the Strategic Petroleum Reserves. This is remarkable because if you look at this, and I'll blow this up for us right here. Historically speaking, on the back, this goes back to 1984, 89, 94, 99, all the way through to right where we are today. And essentially, you knew that the government sold basically petroleum out of our reserves to bring down energy prices, and they did this months before the election to help out. We're not saying it's politically motivated, but the timing was very coincidental, and politics, I don't believe in coincidence in politics, let's just put it that way. But what's interesting, after that, we got through October and November, we're still seeing a decline in the U.S. Strategic Petroleum Reserves. And another 26 million barrels is going to be sold. At some point in time, this has to be built back up. So structurally, we like energy. Even though energy has come off a little bit and energy stocks have come off, they aren't the leaders year to date. We're seeing relief rally in the equity markets. We're seeing sort of those that have been beat up the most, such as technology, lead the way year to date. And some of the lower quality stocks lead the way year to date. The higher quality, let's call it energy, that was a leader last year, has taken a break. But still, crude oil is just under $80 a barrel. And then structurally, we believe that there's tailwinds to support our energy thesis. We think might not be the leading sector of the S&P 500 this year, but we believe it'll be a good quality area to consider when you're building an asset allocation as we are for our clients. Simply because at some point in time, this is going to reverse, and the government's going to have to come in from selling to buying. And that's also future demand right there. So stay tuned next for our special guest, and we'll get right to it. Well, we're back with my special guest, and it's Don Stockhausen. He flew in from Wisconsin, and you brought in the windy and cold weather here in Palm Desert this week, but it was beautiful the last few days here. But Don, it's great to have you back. We miss you.
Thanks, Rob. I appreciate that very much.
We got to come visit you, and then it's getting baseball season.
Yep.
It's going to be fun. How's the Brew Crew? What's the beat on them?
The Brew Crew will go as far as their starting pitching takes them, because they have three of the top starters, two guys that are in the category of potentials, one Cy Young winner and one like third in that category, and Woodruff and Burns. And so they're kind of loaded in that, but the deficiency in the bats is the question. Now the rules changed. So that there's no shifting going on the infield.
So no shifting,
that
right?
Yep.
You have basically they made the bases larger.
Yeah.
So it's a shorter distance to increase potentially more stealing.
Steals, right.
And they also did the pitching? They have to basically, was it 15 seconds?
Yeah, unless there's somebody on base, and then it's 18 seconds or something.
Then it's if they only have 2 tries to first base, the third try, or wherever, pickoff attempts.
Yeah.
And the third try, the guy gets to go the advance.
Uh-huh.
And what is the final one? Let's see.
Oh, that's the extra innings. It's still going to start with a runner on second base and nobody out in the extra innings. Yeah.
Okay.
Trying to move it along.
And then there's another one, I think. But no, this is all going to be exciting. Rule changes. Don is a baseball fan. I'm a baseball fan. Rick's a baseball fan. How are the Cardinals going to do this year?
The Cardinals are always they're always good.
You always have to wait till the Cardinals get past the trade deadline, because that's when they shake things up right before basically August, September, the playoffs. So that always becomes exciting. So, yeah, we're getting excited for spring training coming up here in just a few short weeks. But in the meantime, Don, since I have you and all of your great market history and wisdom and advice, if you will, we've seen a lot this year. We saw, obviously, the markets drew down 10, 15, 20, 30% respectively on some of the indices. We saw oil all over the place, dollar all over the place, the treasuries market. If we look at today, this morning, even on the short-term treasury, we get a 5% yield on short-term money for the risk-free rate of return. That's pretty good. And you also have a rally year-to-date that we're seeing and experiencing. But you have housing and a few other sort of cross-currents. Obviously, inflationary pressures are building through the consumer, through the businesses. How do we navigate through markets like these before? I mean, you've probably seen markets like these before.
No one's seen markets like this before. Right. Let's face it. The truth is, nobody knows.
Yeah.
But, this is probably the most widely advertised potential recession in my long experience of 50-some years of doing this stuff. And but nobody knows, right? And pretty much at the beginning of the year, everybody was shouting caution about the stock market, and then everybody got fooled, right? Mm-hmm. And we're still dealing with it. One thing that I would say is that part of what I do is emphasize dividends and dividends growth to offset inflation. And there are so many excellent companies that have raised their dividends in excess of 10% this year and late last year. And it's still happening. I just happened to go through Barron's this morning, and there must have been 50 dividend increases last week. And
which is great, because this is an indication that companies are still able to navigate through the uncertainty of markets. Mm-hmm. And they're still solid companies, strong balance sheets, well run, and excess free cash flow. What do they do with it? It's either dividends, buybacks, CapEx spending, and a few other options. But you're seeing the dividend plays are a great opportunity. We do a lot of dividend investing for our clients in terms of dividend stocks, and that's the hedge against inflation, especially uncertain times, whether you live off the dividend for income or you just keep reinvesting in dollar cost averaging and obviously compounding, right? That's the eighth wonder of the world.
Eighth wonder of the world, my friend.
That's good. That's good. Well, that's some good advice. We're going to have you back. How long are you out here for?
Another week and a half.
All right. We're going to try to get Don back in the driver's seat right
in
here.
The box.
But I appreciate you spending time with us and our clients and everyone.
We enjoy it. We enjoy the whole event. And now that we have a new office to peruse and still improvements being made, it's really refreshing and fun to see what's going on in Palm Desert.
We're going to try to get you to stay as long as you possibly can because we love hanging out with you, Don. We're going to have some fun.
Okay,
Thanks
Ron.
for joining us today.
My pleasure.